Margaret retired at 62, 31 years as a schoolteacher in Ohio. She had a traditional IRA worth $240,000 and a pension that covered her bills. Her financial advisor told her to leave the IRA alone. Let it grow. You will not need it for years. So she did. She stopped thinking about it. Then she turned 73, and the IRS sent her a letter. This was not a polite annual statement or a routine notice of account status, but rather a devastating mandate that would permanently alter the trajectory of her retirement and systematically dismantle the financial security she had spent 3 decades meticulously building. The letter informed Margaret that she was now legally forced to begin taking required minimum distributions, commonly known as RMDs, from her traditional IRA, a profoundly destructive mechanism that forces retirees to withdraw massive sums of money they do not actually need and brutally taxes every single penny at ordinary income rates. Because Margaret had blindly followed the standard, lazy advice of traditional financial advisors who inherently benefit from keeping your money under their management for as long as possible, her modest nest egg had grown significantly, meaning her forced distributions were massive, violently shoving her out of her comfortable tax bracket and subjecting her to a labyrinth of invisible penalties she never even knew existed. She watched in absolute horror as these forced withdrawals dramatically spiked her taxable income, which subsequently triggered a catastrophic domino effect that completely torpedoed her finances. First, the extra income pushed her into a substantially higher federal tax bracket, meaning the IRS confiscated a far larger percentage of her money than they ever would have if she had proactively managed her account. Second, this sudden explosion in her modified adjusted gross income, or MAGI, triggered a vicious hidden surcharge on her Medicare Part B and Part D premiums, a devastating trap that siphoned away hundreds of dollars a month directly from her fixed income. Finally, and most painfully, this artificially inflated income tripped a deeply unfair IRS calculation known as provisional income, which suddenly caused up to 85% of her previously untouched, hard-earned Social Security benefits to become fully taxable. Margaret was caught in a nightmare scenario, permanently trapped in a cycle of paying taxes to pay taxes, all because she missed a critical golden window of opportunity that is currently wide open for you right now, but is guaranteed to permanently slam shut in the very near future. You are not Margaret yet, and if you want to protect your hard-earned wealth, completely escape these invisible traps, and avoid being financially slaughtered by the IRS in your golden years, hit that subscribe button right now, because we are going to dive deep into the exact step-by-step methodology you need to legally and permanently shield your money. We are talking about the rapidly closing window of historically low tax rates that every single retiree with a traditional IRA must desperately take advantage of before the year 2028, after which the opportunity will be gone forever. Let me start with the absolute foundation of why this crisis exists in the first place, because understanding the fundamental mechanics of your retirement accounts is the only way to effectively neutralize the threat. When you originally contributed money to a traditional IRA or a traditional 401k, you received an upfront tax deduction, which felt like a massive victory at the time, and your money was allowed to grow tax-deferred for decades, compounding year after year without any immediate interference from the government. However, you must realize that a traditional IRA is essentially a ticking tax bomb sitting right in the middle of your living room. Because you do not actually own all the money in that account. The IRS owns a very substantial percentage of it, and they are simply waiting patiently for you to enter retirement so they can brutally extract their share at whatever future tax rate they decide to impose. Conversely, a Roth IRA represents the ultimate financial sanctuary, an impenetrable fortress where you pay the taxes up front on the seed, but the entire harvest, including all future growth, dividends, and withdrawals, remains absolutely tax-free forever, legally entirely out of the reach of the IRS. The strategic process of moving your funds from the dangerous, fully taxable environment of a traditional IRA into the permanent tax-free safety of a Roth IRA is known as a Roth conversion, an incredibly powerful financial maneuver that allows you to voluntarily pay taxes today on your own terms in order to completely eliminate the catastrophic risk of being forced to pay significantly higher taxes tomorrow. Now, let me explain the massive catalyst that makes executing these conversions right now the absolute most urgent and critical financial priority of your entire lifetime. In 2017, the federal government passed sweeping legislation that dramatically and historically lowered federal income tax brackets across the board, providing a once-in-a-generation opportunity for retirees to withdraw money from their traditional IRAs at incredibly cheap, deeply discounted rates. Under this temporary legislation, the old 15% bracket was slashed down to 12%. The old 25% bracket was dropped to 22%, and the oppressive 28% bracket was reduced to 24%, creating massive, unprecedented breathing room for strategic tax planning. But here is the terrifying reality that most retirees completely fail to grasp. This legislation was never designed to be permanent, and by absolute undeniable law, these historically low tax rates are scheduled to permanently sunset at the exact stroke of midnight at the end of 2025. While the actual legal expiration occurs at the end of 2025, the practical multi-year window to effectively maneuver your complex conversion strategy gives you until roughly 2028 to fully execute your plan before the compounding long-term damage of the returning higher tax brackets completely annihilates the purchasing power of your remaining portfolio. When this sunset inevitably hits, taxes are going to automatically skyrocket without Congress even having to lift a finger or hold a single vote, meaning the exact same dollar you could easily convert today at a perfectly manageable 22% will violently cost you 25 or even 28% just a few short years from now. Let us transition from these abstract laws to look at the concrete, undeniable mathematical reality of what this actually costs you. If you currently hold $500,000 in a traditional IRA, and you strategically choose to convert exactly $50,000 a year under the current highly favorable 22% tax bracket, you will pay exactly $11,000 in federal income taxes for that specific conversion. However, if you sit back, do nothing, and wait until the brackets legally revert, pushing you violently back into the 25% bracket, that exact same $50,000 conversion will suddenly cost you $12,500, representing a completely unnecessary $1,500 penalty purely for your own hesitation. Over a critical 10-year conversion horizon, that translates to a staggering $15,000 vanishing permanently from your family legacy and going straight into the pockets of bureaucrats in Washington. And that does not even begin to factor in the explosive lost opportunity cost of the tax-free compound growth you permanently sacrificed by waiting. Now, let me show you three vastly different people to vividly illustrate exactly how this critical tax window plays out in the real world and how different choices lead to completely opposite financial destinies. First, we have Dorothy, a highly proactive 65-year-old single retiree who recently left the workforce with roughly $300,000 saved entirely in her traditional IRA, living comfortably off a modest corporate pension and her monthly Social Security benefits. Dorothy astutely realizes that her relatively low fixed income places her squarely inside the historically cheap 12% tax bracket. So she makes the incredibly intelligent decision to systematically convert $20,000 a year from her traditional IRA directly into her Roth IRA. Because she heavily utilizes her standard deduction to legally offset a massive chunk of her taxable income, she is paying almost absolutely nothing in federal taxes on these annual conversions, essentially moving her money from a taxable environment to a tax-free environment for pennies on the dollar. By the time Dorothy actually reaches her mandatory RMD age, her traditional IRA will be virtually empty. Her Roth IRA will be overflowing with completely tax-free wealth, and she will have permanently immunized her entire financial existence against any future tax hikes the government tries to impose. Next, we have Robert and Carol, a married couple, both exactly 68 years old, sitting on a massive combined traditional IRA balance of $1.2 million, living a very comfortable lifestyle that currently places them in the 24% tax bracket. Robert and Carol stubbornly decide to wait, firmly believing that voluntarily paying taxes right now is fundamentally foolish, completely ignoring the ticking clock of the 2028 window and assuming they can just handle the taxes whenever they eventually need the money. Fast forward just a few years, the tax brackets violently revert to their historical norms, and suddenly Robert and Carol are slammed by their required minimum distributions, legally forced by the IRS to blindly withdraw over $45,000 a year, whether they want to or not. This massive forced withdrawal aggressively pushes their modified adjusted gross income completely into the stratosphere, forcing them to pay taxes at the newly restored 28% rate. But far worse, their soaring income triggers an explosive secondary tax that absolutely devours their monthly cash flow. Finally, we have James, a 70-year-old single man who holds exactly $800,000 in a traditional IRA, who suddenly hears a terrifying news report about the golden window closing and immediately spirals into a state of absolute financial panic. Desperate to beat the looming 2028 deadline, James rashly decides to convert a massive $150,000 all at once, thinking he is brilliantly outsmarting the system by getting all his money out before the tax rates inevitably skyrocket. But James made a fatal, catastrophic mistake, because by executing a massive, entirely uncalculated conversion, he accidentally triggered 3 deeply destructive financial traps that completely wiped out his savings and left him in a far worse position than if he had done absolutely nothing. Here is exactly what I need you to profoundly understand about these 3 specific traps so you can completely avoid stepping on the same explosive landmines that completely obliterated James's retirement dreams. Trap number 1 is the terrifying phase-out danger, a completely invisible threshold where the IRS begins systematically stealing away your legal deductions and critical tax credits simply because your income appears artificially high on paper. When you execute a Roth conversion, every single dollar you move is immediately added to your taxable income for that specific year. And if you are not incredibly careful with your mathematics, you will completely phase yourself out of vital deductions, accidentally pushing yourself entirely out of the highly coveted 0% capital gains bracket and violently forcing yourself into the 15% bracket, meaning you are now suddenly paying massive taxes on long-term investments that would have otherwise been completely and permanently tax-free. Trap number 2 is the devastating IRMA cliff, which stands for the income-related monthly adjustment amount, a deeply insidious, entirely hidden stealth tax applied directly to your Medicare Part B and Part D premiums based strictly on your modified adjusted gross income from exactly 2 years prior. Medicare fundamentally does not care if your sudden income spike was just a one-time, highly strategic Roth conversion meant to protect your future. If James accidentally pushes his income even just one single solitary dollar over the rigid IRMA threshold, his monthly Medicare premiums will automatically and dramatically skyrocket for an entire calendar year, stripping thousands of dollars directly out of his checking account because there is absolutely no gradual slope or forgiving phase-in period. It is a literal, brutal cliff that you simply fall off. Trap number 3 is the absolute worst of them all, the Social Security torpedo, a vicious mathematical trap where the IRS utilizes a highly specific, deeply confusing formula called provisional income to explicitly determine exactly how much of your hard-earned Social Security benefits are suddenly subjected to brutal federal taxation. Provisional income is strictly calculated by taking your adjusted gross income, adding any supposedly non-taxable municipal bond interest, and then adding exactly 50% of your annual Social Security benefits, creating a highly inflated phantom number that the IRS uses against you. If you blindly and foolishly convert too much money from your traditional IRA in a single year, you will massively artificially inflate your provisional income, and suddenly up to 85% of your previously totally untouched Social Security benefits will instantly become fully taxable at your highest marginal rate. You are literally paying a massive unexpected tax just to pay another tax, completely and utterly destroying every single mathematical benefit of the Roth conversion in the first place, and leaving your portfolio bleeding out on the floor. This is the profound, undeniable danger of invisible taxes, proving that you absolutely cannot just blindly convert your money and hope for the best. You desperately need a precise, highly calculated, almost surgical strategy to permanently escape the traditional IRA tax trap before the golden window aggressively slams shut forever. So, how do you actually do this correctly? How do you completely protect your money, secure your legacy, and legally outsmart the IRS without accidentally stepping on a devastating financial landmine? Here is your absolute, definitive, 7-step actionable checklist to perfectly execute a flawless Roth conversion strategy and completely secure your wealth before the 2028 deadline permanently eliminates your options. Step 1, you must fiercely and meticulously calculate your current provisional income to the absolute exact penny, meaning you need to immediately pull out your most recent tax return, look directly at line 11 to find your exact adjusted gross income, and explicitly determine precisely how much mathematical room you actually have left before you violently trigger the catastrophic Social Security torpedo. Step 2, you must clearly identify your specific target tax bracket ceiling, looking incredibly closely at the current 12%, 22%, and 24% brackets to find out exactly how much more additional income you can legally recognize this specific calendar year before you accidentally bump your head into the much more expensive next bracket. And that exact difference becomes your absolute maximum safe conversion allowance for the entire year. Step 3. You must rigorously check the incredibly dangerous IRMA thresholds, meticulously cross-referencing your precisely planned conversion amount with the official Medicare premium brackets to strictly ensure that your total conversion plus all of your other expected income sources lands at least $1,000 safely below the nearest IRMA cliff to give yourself a critical, life-saving margin of safety against unexpected year-end dividend payouts or sudden capital gains distributions that you cannot control. Step 4. You absolutely must scientifically map out your future RMD trajectory utilizing an advanced online calculator to accurately project exactly what your traditional IRA balance will mathematically grow to by the time you reach age 73, allowing you to explicitly calculate what your forced, highly taxable withdrawals will be, which will instantly show you exactly how aggressive you desperately need to be with your conversions today to successfully defuse that massive future tax bomb. Step 5. You must always, without exception, pay the conversion taxes from a completely outside source, never ever allowing the financial institution to withhold the taxes directly from the IRA conversion itself. Because if you convert exactly $50,000, you must move the entire full $50,000 safely into the Roth IRA and independently pay the $11,000 tax bill from a standard checking, savings, or taxable brokerage account. If you foolishly withhold the taxes directly from the IRA funds, you permanently and irreversibly lose the incredible compounding tax-free growth on those specific dollars for the rest of your life, crippling the long-term effectiveness of the entire strategy. Step 6. You must strategically execute the actual conversion in calculated, deliberate tranches, never doing the entire massive amount all at once in January, but rather systematically converting a small, safe portion in the early spring, moving a little bit more during the summer months, and then performing your final hyper-precise calculation in late November or early December when you finally know exactly what your total comprehensive income for the year will actually be, entirely preventing any catastrophic accidental over-conversions. Step 7, you must religiously reevaluate this exact mathematical process annually, recognizing that the federal tax code is a massive, living, breathing monster that constantly shifts, meaning you must rigorously rerun every single one of these complex calculations every single year between right now and 2028, because your portfolio balance will fluctuate, your standard deduction will change, and the IRS bracket limits will shift slightly due to annual inflation adjustments, meaning you absolutely must treat this entire process like a multi-year, highly precise surgical operation. If you diligently and faithfully follow these exact 7 steps, you will systematically and safely drain your dangerous traditional IRA, voluntarily pay your taxes at historically unprecedentedly low rates, completely avoid the devastating IRMA cliff, fully protect your hard-earned Social Security benefits from unfair taxation, and permanently build an absolute impenetrable tax-free fortress of wealth inside your Roth IRA that will protect you and your family for generations. You are not Margaret yet. Her critical window of opportunity permanently closed because she foolishly listened to lazy, outdated advice and completely ignored the loud ticking clock of impending tax legislation. Your golden window of opportunity is still wide open right now, But the sand is rapidly running out of the hourglass, and the government is already planning exactly how they are going to spend your retirement savings. You have a profound, unavoidable choice right now. You can either choose to do absolutely nothing, lazily wait for the historical tax cuts to permanently sunset, and submissively let the IRS violently force you into massive, completely unavoidable tax bills when you inevitably turn 73. Or you can bravely take absolute control of your financial destiny, rigorously run the exact numbers, and legally, permanently shield your entire life savings from the greedy hands of the government. Tell me in the comments, are you currently doing Roth conversions to protect your wealth, or have you been nervously waiting on the sidelines? I personally read every single one of your comments, and the absolute most common situations I see down there directly become the exact topics for my future videos. Also, please do not let your good friends or your beloved family members fall blindly into the exact same devastating financial traps as Margaret did. Share this specific video right now with anyone you know who currently has a traditional IRA so we can effectively save their hard-earned finances too. Do not forget to absolutely smash that like button and immediately subscribe to the channel for more highly actionable, step-by-step strategies to permanently protect your wealth and completely outsmart the system.